I need to welcome all people on Zoom that are watching, hopefully. Uh, is we need to thank Jane for coming up with that idea and being able to offer this not just to the community, but for the senior centers in Manitowoc and Fond du Lac and all these other places. When I did post it on Facebook that it would be broadcast, I got a lot of responses from people that are looking forward to that. So hopefully I don't let you down. Um, you know, I have a lot of really good days in my life ever since like 1992 when I, you know, kicked the work thing and just started to live my life the way I wanted to. And Sunday was one of those days. This is like a typical day for me, but it was like a little extra special day. I got to get up first thing in the morning, and my niece has this awesome Labrador retriever named AJ. So I get up and walk AJ every morning. I take him out to the trails and I go through the swamps and the woods. It's like back when I was a kid. So much fun. And we put in like usually 6 to 10 miles a day, gets him tired out. And it's a good start. It gets me warmed up for the day. So I did that Sunday. And then I get home, got something to eat. And then I went to the office. And the office to me is the golf course, of course. So it was a particularly nice day for golfing, and there really wasn't a whole lot of people on the golf course. So we just kept playing and playing and playing. And pretty soon it got to be the sun started going down. So I thought, oh, it's time to go home. And luckily I'm married to the best woman in the world because she puts up with that. But anyway, I get home and fix something to eat, and I happen to look in the refrigerator, and I only have like that much chocolate milk left. And it's like, you got to have chocolate milk in the house, right? So I'm going like, oh, I need to go get some. So I got in the car and I went over to the local gas station, and I got a gallon of milk. And I went up to the counter and there's a lady there. And I was about to check out. And from the background, I hear this voice. And it says, oh, that man's a teacher. He's a teacher. I think I'm going to his class. And it was like, I looked and a lady came out from behind her and she said to the other lady, I'll take care of him. And she came up to the counter and she had this enthusiastic look on her face. She's here tonight, but I won't embarrass her by telling her to stand up. But she was so excited to tell me how much she enjoyed the class, and she was looking forward to learning so much about this because she said she didn't know anything. And just the sparkle that she had in her eye and the enthusiasm she had for seeing me and being able to tell me this just made my day. So I want to let her know how much that brightened my day. Even though I had a good day, it made it great. And it's one of the blessings of doing this, because I get that every so often around town. And when I'm in a store, a gas station, or whatever, and one of the former students sees me, it's always the same. So there's lots of things in life money can buy. Can't buy that. Just can't. So I had a great day. All right. Before I do the actual class, you asked me last week about you had a 1-year-old, because I did that lesson that the gentleman behind you. He has a 1-year-old and 3-year-old. And after the class, I got to thinking about it, because I gave you kind of a complicated answer, like opening a brokerage account, putting money into an ETF of the total stock market index fund. And then you also asked about college education. And I said, probably a Roth IRA. And then, so I'm a big advocate of trying to accomplish the goals that you have as simple as possible. And so I made it too complicated for you. So I wanted to make it easier for you. And so here's what I came up with. You have basically 4 goals in your life. You're saving for retirement. You're putting money, you should anyway, be putting some money away for a nest egg for rainy days. In case something happens and you get into a financial straits, you don't have to go out and borrow money or put it on a credit card. It's really important to have money put away that you can access Your third thing you said is you want to put a kitty away so that you can help your kids get their financial life going, like I showed you. And finally, you wanted to put money away so that maybe you can help them with college. So here's the easy way. I mentioned a Roth IRA. So anybody with earned income can open a Roth IRA, and you can open one for you or your wife. I'll get more into this later in the last lesson of the overall financial plan, but to address those four things, you actually can accomplish all four of your goals that you stated by opening a Roth IRA. Because with a Roth IRA, when you put money in, after 5 years, you actually, at any age, can take the money out of a Roth IRA without penalty or without taxes. So you mentioned that you want to be able to put money and then take it out, because when your 3-year-old gets to be 16, I mentioned she should open a Roth IRA. Actually, if you would do like, say, $150 a month, and their age is 1 and 3 right now. So we're talking 13 to 15 to 16, 17 years. If you continue to put like $150 a month into a Roth IRA, and you could use the total stock market index fund, by the time they get up to high school and that age when I said you transition money, because you can take money, any money you put in, you can take out, and you will have contributed between $20,000 and $30,000, which you can access to do those things you want with that. And you leave the remainder in for your retirement savings. You got that? So you actually can knock it out of the ballpark by doing all that just with the Roth IRA. And if you do follow through with it, what I would suggest you do is give yourself a 10-year window if you start now with the stock market. And then when you get 10 years from now, your 13-year-old will be, your 3-year-old will be 13. At that time, what I would suggest you do is you would balance it out. So all you do is would call, if you do it at Vanguard or you do it at Fidelity or you do it at Schwab, you just call them and say, gee, I'm going to do a lesson next week on bonds. So whatever we're in the bond cycle, you could tell them to put half of the money, take it out of the total stock market index fund and put it in this bond fund. Now, the reason you're doing that is you have a window of only 3 to 5 years. You're going to be taking money out of this. So you want to make sure the total stock market index is it's the stock market. So it can be very, very volatile. Supposing your kid gets to be 16 years old and you have, you've contributed $25,000 and had grown to $50,000, and all of a sudden you have a sell-off of 50%. I mean, it pretty much wipes out all the capital gains. It can happen. And so if you just have like half of it put in a bond fund, then you could do these withdrawals for your kids to help them get started and for college education in a bond fund that's much more stable, and you're not touching the stock part. And so whatever volatility range it is, if it's negative, you aren't withdrawn. You're not selling that part, because that's the long-term plan for your retirement. Sound good? Much simpler too. Okay, great. All right. So this particular lesson is probably the cornerstone of what I do as an investor. Like you have a car. What makes the car move? It's your engine. It's the engine that gets the car moving. And really, when you're talking about investing for retirement, or even if you're retired, you need growth. And the growth part is the stock market. But the stock market is extremely volatile. It's extremely complex. And there's all different kinds of ways that people invest in. But, it's very, very difficult for the average person to have the time or the expertise to do it. And so oftentimes they rely on other people to handle their money. Well, the great news is, and I can attest to this in my own life, and you'll see from this lesson, is that you can get the performance of the billionaire, the multi-billionaire, who has all these fancy people that are really expensive to have to handle their money. You can get the returns that will match them or even beat them. And you can do it for a small amount of money. And you can do it without having to watch the stock market every day, and you don't have to trade, and you don't have to have expensive accounts, and you can do it tax efficiently. And that's through the use of an index fund. Particularly an index fund we call a total stock market index fund. Oh, before I go, I have one thing I might have. This is on Zoom, so I need to always do a disclaimer. I am not a financial planner. I am not a financial professional. This is not my job, so don't please ask my card. Anything I talk about is my personal opinion, and I will talk about it and explain things, and it's not a recommendation. It's giving you information so that you make choices. I've had so many people ask me, "Oh, could you take care of my stuff for me?" And this is, I'm more than willing to help people with their investments as much as I can. But, you know, I don't want to be someone's financial manager. I want to help people become empowered enough that they can start making financial decisions for themselves. And that's what this class is all about. And it's so awesome when you get to that level. And I'm telling you, if you keep coming to these classes, you will get to that level. You can, everybody can. So let's talk about the total stock market index. Before that, I have a wonderful quote here. It's a quote from a guy that was the chief investment officer from Yale University named David F. Swenson. You may have heard of him. And Mr. Swenson said that the fundamental market failure in the mutual fund industry involves the interaction between sophisticated profit-seeking providers of financial services and the naive return-seeking consumers of investment products. So I really center on the naive. You know, I am naive in so many things, like Zoom and so many of the technology things. I will fully admit that, but I become more and more functional in it. We're all naive in certain things, but so many people are very naive about investing and financial things. And it has nothing to do with your intelligence level. In fact, a side note here, I was once reading a book in which the author pointed out, do you know what Mensa is? I mean, you walk around with your nose in your head because you're in Mensa, because you're supposed to be like the smartest of the smartest people. The Mensa Club, and it's an elite club of really smart people. They decided they're so smart, why not apply our intelligence to investing? So they set up an investment club. Guess what? The performance was pathetic. So I'm not saying there's not some degree of intelligence involved in here, but you know, I remember back in the days when you know, the stock market was doing great guns. You would read articles every once in a while in the Wall Street Journal or one of the financial magazines where they took a chimpanzee and they gave the chimpanzee a dart and they would throw it at the board. And then they compared and then whatever stock it landed on, you'd buy that stock. They ended up that the chimpanzees were outperforming the financial managers. So there's no denying there's a great degree of intelligence into analyzing stocks and so forth, but there is a lot of randomness to it, and it's very, very difficult to consistently outperform the collective. And what is the collective? The collective is the actual return of the stock market itself. So your first step in becoming non-naive investors is to understand how much you don't know. And the second thing is being humble enough to accept the fact that there's a lot of people who are actually setting the prices of the stock market that are a whole lot more brilliant than you and I. You understand the stock market's prices is set every day through basically a buying and selling, supply and demand of every individual stock. And it's roughly 90 large financial institutions in our country that do most of the trading on the stock market. And it's these big financial firms through their buying and selling of stocks that actually set the value of the stocks in the stock market. It's not the mom and pop people who are buying and selling. It's really very sophisticated, knowledgeable people who are evaluating these stocks and buying and selling them to set the price of it. And it's done every day. And so basically you're just an investor in this process. And you can do it through many different ways. You can do the buying and selling. And I kind of discourage the individual buying and selling of stocks. Why? Well, anybody in here ever play high school basketball or football? Oh, come on. Somebody in here must have done something. Okay, so you were a football player. What position did you play? Offensive line. All right. So you're a pretty big guy. Were you a pretty good player?
I was smaller back then.
Oh, you're a soft. For your people on Zoom that didn't hear that, he said he was smaller back then. Anyway, my point would have been is you're an amateur, right? And you played offensive tackle, let's say. Well, how would you like to line up against, like who's Penny Clark from the Green Bay Packers? One-on-one, you go against him, you block him and try to prevent. He would like pile drive you, right? So the difference between amateur football players, amateur basketball players, amateur tennis players, amateur golfers, amateur anything, and professionals is like night and day, isn't it? So you want to go out there and buy stocks. Well, who are you buying them from? A professional. The people who you're buying them from are professionals. You're competing against professionals. If you're doing this and you're buying and selling and you're trading, you might get lucky, but eventually you're probably going to get really underperform versus what the professionals are doing. And because you don't have the money that these big firms do, when you make a mistake, it has much more impact on your life than when a professional maybe picks a stock that doesn't turn out so well. He can liquidate it, and because of the huge volume of money he has invested, it's not so significant in the long-term performance of the thing. For you, it's a big deal. And that's why I just am not a big advocate of going out and buying individual stocks. Now, once again, if you want it as a hobby, fine. But like I say, I would take up fishing or golf. But anyway, okay, so index investing. Well, when we're talking about indexes, I need to explain the difference between managed funds and index funds. So to do that, just do some. Okay, we'll say this is a managed fund. Put it in there. And this would be an index fund. And by that, I mean an index mutual fund. And then over here, we have another index product, and that is called an ETF. And this has been the rage in the financial market. And when I'm talking about the way I invest, I really don't mess around too much with ETFs. And I'll explain the difference. I'll get more into why I don't necessarily use them. because I think the index mutual fund suffices everything that I need. Okay, so a managed fund. All right, we have this universe in the stock market, and we categorize stocks. So you have one of the words that you'll hear financial people use is capitalization. Notice I didn't spell that out. It would take too long. Capitalization. You hear market cap. That means market capitalization. Market capitalization simply means you take the share price of a stock, and every company has a certain number of shares that they call the float. That's the shares that are open for people to buy and sell. So you take those shares, and let's say it's 10 million. And then you look at the share price, and the share price is $1. Okay, that means the market capitalization of that stock is $10 million. So we categorize companies in the stock market to explain the stock market by their market capitalization. And the market capitalization of the stock market is broken down into small cap stocks. And small cap stocks are they're less than like $1 billion in market capitalization. And small cap stocks roughly make up about 10% of the market capitalization of the stock market. And then we have mid cap stocks, and mid-sized companies make up about 5%. And 75% of the stock market is the large cap stocks. So when we talk about the stock market and the actual valuation and the value of the stock market and where most people invest in the stock market, it's these giant companies. The market capitalization is predominantly 500 companies. And a company called Standard & Poor's identified that and tracks it, and it's called the S&P 500. So when you're looking on TV and they're talking about the S&P 500, they're talking about 500 companies that represent 75% of all the money that's invested in the stock market. And then you have the small part is the small and mid cap companies. Okay, so when we're talking, and then the other way we break it down too, and this is, I'm going through this because you need to know this to identify these mutual funds that you're investing in. So another way we break companies down in the stock market is we call them growth companies or value companies. And it's really kind of difficult to give you just an absolute answer to identify a growth company and a value company, because sometimes companies are growth companies and then they turn into value companies. Sometimes value companies turn into growth companies. It gets very, very confusing. But the simplest way I can help you to understand them is a growth company is a company that has the potential to grow at a much faster rate than most of the other companies in the stock market. Oftentimes, these are tech companies, biotech companies. They have a biotech company can all of a sudden get approval for a certain kind of drug, and all of a sudden it can go up 1,000% in a year. It's just amazing the explosive potential of growth companies. And then you have value companies. And value companies, they grow at a slower rate. Their earnings are more in line with the economy. Sometimes they're called undervalued stocks because maybe the market's sold off because they dislike something they're doing. But then those companies have the potential to straighten things out, and then they turn into growth companies. That's why they go on both sides of the scale. But generally, when you're an investor, the thing that you should know that is, if you're investing in growth companies, you're probably going to have more volatility and more risk than in you're investing in value companies, because the value companies kind of like, another way I used to explain it to the kids in high school is, growth companies make the things we want, and value companies, they make the things we really need. like utility companies, food companies, stuff like that. That's kind of how the companies fall in. So when we're talking about this universe of mutual funds that you are choosing from, the managed mutual funds are broken down into companies that specialize in these various sectors or subcategories of the stock market. So when you look at your company retirement plan and it says the large cap growth fund, it means that that manager is searching the stock market in the growth stock area and large companies, seeking to pick stocks and add value to your money and hopefully give you a return that even is better than the stock market. Because every one of those managers that are managing managed funds knows that there is an index. And an index is a basket of stocks that represent a part of the stock market or all of the stock market itself. I gave you one indication of the S&P 500 index. So these 500 companies that represent 75% of the stock market is the S&P 500. And if you're a large cap manager, you're investing, those are the 500 companies that get analyzed. And all these managers are picking from them. You got that? And then small cap, mid cap, correspondingly. So basically, the difference between a managed fund, one of the big differences between a managed fund and an index fund is the manager is actually not necessarily buying all the stocks. He's buying the ones he thinks are going to outperform the index itself. All right. And as I explained in last week's lesson, you are paying a premium for that expertise. There's a lot of buying and selling involved. There's a manager, there's the company that owns the mutual fund. There's shareholders that demand a profit, so they have to have a profit for the business. It's all these layers of expenses that you have involved in these managed funds, where you're paying, can be paying 2%, 3%, even 4%, and annual expenses on your money to invest. And what you're doing it for, if you're going that route, is that you have the option to outperform the stock market. That is the attraction. And let me go back to Mr. Swanson's point here. Naive, profit-seeking, they're return-seeking consumers. This is how they're sold. There's always going to be managed funds that outperform their indexes. There always will be. It's simply, you can never have it where the index is outperforming everything, because that's not possible. There's always going to be people that outperform the index. And that is the selling point. That's what attracts people. That's what motivates people. You can call it greed, but I don't like to call it greed. I think oftentimes people are just naive at the risk they're taking and the odds that are against them. I think if most people were educated at how difficult it is to beat the market by picking stocks, they would use indexes. It's just a matter of education. And now stop and think about it. Do you think the financial service industry wants you to know this? Because if you have expenses and you're making so much money, when you look at an index fund, and I talked about them last week, you're talking about a managed fund. If it has an expense ratio of 70 basis points or 3/4%, and then you add in the transaction costs and any other fees and all the opportunity costs and all these expenses that I listed, Money Magazine says take the 3/4% and multiply it times 3. And now you're over 2%. And you look at an index fund, and the index right here, the difference is, let's say you pick a total stock market index fund. Well, guess what? That manager has to go out and buy all the stocks of the stock market in proportion to the market capitalization of the stock market itself. So I believe the last time I checked, the largest market capitalization stock in the stock market was Apple Computer. And I think its market capitalization was 3% of the stock market. Think about that. 3% of all the money that's invested in the stock market is in one stock, the Apple Computer. So if you sent $100 into the total stock market index fund, that means $3 are going to Apple. And then the next company down, a proportionate, all the way down to fractions of cents to the smallest of companies. In other words, when you put money in a total stock market index fund, your money gets diversified into the market as it exists, so that at the end of the day, if the stock market was up 1%, you were up 1% because you owned all the stocks of the stock market as they exist in your market capitalization. That's the attraction of it. And it can accomplish that because it's so efficient to run, and there's so low of expenses. In fact, you talk about people that work for the federal government, you have the thrift savings plan. It's like 2 basis points. I think Vanguard, if you're in a big company and they have what's called institutional indexes and they have the total stock market index, they have an expense ratio of 1 basis point. I think, I don't know, I don't advocate that fund, but I believe Fidelity has a loss leader one, and it's a total stock market index fund. It's called the Zero, and it has no management fee. I don't know how they come out on that, but I'm sure that they find some way. But anyway, the point is that the expenses are next to zero. So she said there's no expense. To be honest with you, she asked, it's called the Zero Fund. And technically the advertising sales pitch of the total stock market index through Fidelity of the Zero Fund is that there's no management fee. That's what they say. Now, I've never read the fine print, but to me, they have to be covering the expenses some way, right? So I have not used that fund because I'm a former businessman, and I know you don't stay in business long if you're doing stuff for free and it's costing you money. I'm the only guy that does stuff for free and knows as much. I don't think the shareholders that invest in Fidelity would sit back and say, oh yeah, let's just wipe out all our management fees and let's just keep losing money, because it's really a good idea for business, right? And so I don't know what the catch is to it, but I'm perfectly happy I use Vanguard's, and I'm very, very happy with it. So anyway, and then you can make indexes of the 2 primary indexes that you see in company retirement plans, and the ones that I would drift towards. My favorite is the total stock market index fund, because I'm assured of getting the returns of the stock market. But then the S&P 500 is the performance of it is very close to the total stock market index fund. So oftentimes people say, oh, which one's better? And the truth is that if you're in the S&P 500 index fund, you have the total stock market index fund, except you don't have small and mid cap stocks. You know what I mean? And so I like to have the diversification of the small and mid cap stocks. So do you understand index funds? Now, as I said, an index can be anything. So we have different subsectors of industries in the stock market, and this has become the rage of the financial markets. They understand that a lot of people are getting smarter and they don't want to try to compete by buying and selling stocks, but they've rolled out a new product in which they package as an index, but it's an index you can trade. So like, this is a mutual fund. So with a mutual fund, if you put money into it, your money gets invested, and the money doesn't get invested till the mutual fund closes for business at 3 o'clock. So if the total stock market index fund closed tonight at $110 and you wired money to Vanguard and it got there tomorrow morning, you wouldn't buy the shares necessarily at $110. Your money would get invested at what the share price is when it closes for business tomorrow. You get that? So you can't just like in the middle of the day, call up Vanguard or Fidelity and say, oh, sell my stuff. And then you're selling it right at that price. You know what I mean? It's not that liquid. It's liquid, but not that liquid. Okay, so what the financial service industry said is we could create a product that we package as an index, but only will make it so that people can buy and sell it at any time, 24 hours a day, 7 days a week. And they do this, and it's called an ETF. So you could have, like Vanguard has an ETF of the total stock market index fund. And the composition of the stocks inside of it are identical to their mutual fund of the total stock market index fund. However, it's packaged into a unit in which there's a certain number of shares outstanding. Like with a mutual fund, there's an unlimited number of shares that can be distributed because the more money comes in, the share prices go up, the shares go up. They create shares that way. But in ETF, there's only a certain number of shares that are created. And so the share price is determined by the buying and selling of it, but and it trades like a stock. So that's the difference between it. Has really low expenses, it's tax efficient, has the features that make indexes attractive. But the difference is you can trade them 24 hours a day and 7 days a week. Probably one of the reasons why I don't like them is because of that temptation. You know what? I mean, sometimes, you know, you don't, if you're an alcoholic, you don't go to the bar to kick the drinking habit. If you're a smoker, you don't hang out in bars and places where people are all smoking, right? You try to get away from it. Well, trading, and I have a chart which I'll show you, is statistics has backed me up with this. It seems like the more you trade, the worse your performance. That's what we have found. The higher the number of trades that people make, the lower the performance decreases. So I don't want that temptation to trade. So and there's another reason why I don't use ETFs, and I'll talk more about that later in another lesson. And it hasn't been tested yet, but it's one of these little quirks that people don't understand about the compositions of ETFs, which I think at some time could cause. Are you familiar with what's called the flash crash? I don't know how many years ago this was, but we had a day in the stock market in which unexpectedly, a huge number of stocks just absolutely crashed. And no one could understand it. You know, what happened there? And I never did hear why it was. They blamed it on some computer errors or something like that. But you know, if you look at the composition of an ETF and how they're constructed and what makes them work, you'll find that there's things behind them that could possibly get stressed or tested in a very, very volatile market. So I'll get into that more. But for now, you just need to understand what they are. These are the various ways people invest in the stock market. And so I'm making this case tonight to try to help you to understand why myself and many, many other people have abandoned the managed mutual funds part. And it's not just because of costs, and gone to an index fund. And I use the total stock market index fund. So you're like the jury, and I'm like the attorney up here laying my case for the attractiveness or why this is the winning strategy here. And I'll see how you vote when I'm done. Okay. Okay. So one of the reasons why I like using an index fund, it's about risk. I find that investing itself has risk. And when you're investing in an index fund, I said there is risk. You are investing in the stock market. What makes the stock market go up and down? I am going to do a whole lesson on that to some extent to help you to understand it, but it really boils down to the economy. And why is the stock market been so weak? Because the economy is doing really, really well. Well, there's things that, to me, it's kind of like looking at a house. Oh, it's a beautiful house. But what you don't see underneath the boards is there's a bunch of termites in there. You know what I mean? There's stuff in our economy that's really destructive. And the professionals who know about the economy understand that, if these things don't get rectified, we are headed for some real stresses on our economy. When stresses on the economy means earnings of companies are going to decrease because the economy is going to slowing down, if not going into recession. And if earnings go down, what do you think the valuation of the stock is? It goes down, right? Okay, so when you're investing in an index fund, and that's why I love doing the lesson on the economy, is the risk you're taking primarily is just economic risk. You're investing in the stock market, and if the economy is doing well, the stock market does well. If the economy is not doing well, the stock market's not going to do well. That's the risk you're taking. But there's so many other more risks when you go along with managed funds. For instance, you have the market risk, but you also have manager risk. You're giving your money to this unknown person. And how many people in here invest in managed funds? You're liars. How many people in here have company retirement plans? Okay. And in your company retirement plans, you have a whole portfolio of mutual funds you're investing in. They're primarily managed funds, right? Most people, so most people have managed funds in their portfolio. And do you know the manager? Do you have a personal hotline to him? Do you have any idea about the manager? Because your whole financial life is dependent on what he's doing. And yet, that's a risk, isn't it? You have no control over it. They can do anything they want within the law, and they have your money. You're just giving it to them through your investing. You have no control. You do have control when you use a total stock market index fund. Because if you send it to Vanguard or Fidelity and it's a total stock market index fund, the manager of that fund, which basically is a computer that does most of the work, he has to invest it. He can't say like, Apple, it might be the largest capitalization stock on the stock market, but I really can't, I don't like it. So I'm going to only put 1% of the people's money in there. You know what I mean? That's his bias, his decision. He can't do that. Can't do it by law. It's a total stock market index fund, so it has to be representative of the stock market. So for once in your life, when you invest in a particular financial product, you are in control. You are making the decision exactly where your money goes. How empowering is that? That company that you're investing, they can't do anything with it. You control it and you're making the decision. And at the end of the day, you know where your money's invested. Not that you know every stock on the stock market, but you know that it's the total stock market. And you will know the performance of it based on the performance that you see of the stock market. It's so empowering, and it reduces that manager risk. It's really interesting. The average tenure of a manager in a mutual fund is 3 years. They're like baseball managers. So you might have, oh boy, I got a great fund, and the manager does a good job. And all of a sudden, what does he do? Hasta la vista. I can make more money in a hedge fund, so I'm off there. You know what I mean? They come and go so fast. So that's a risk. The cost risk, of course. Think about this. If the expense ratio is over 2%, and it's really hard for a managed fund to get under that 2% when you take all the different expenses that are involved in investing. That historically is 20% of the return to the stock market. So what activity do you know where you see outperformance if the opponent is starting 20% ahead of you all the time? Man, think about how hard that is. That is a risk. So if the expense ratio is 2%, that means you have to make 2% on your investments before you start making any money. You use an index fund that has expense ratio of almost zero from day one, whatever you're making is a profit because it's not being consumed by the expenses. Tax risk, all this buying and selling. If it's not in an IRA or a company retirement plan, Uncle Sam is calling it at the end of the year. A mutual fund can be extremely tax inefficient. I love to talk about this particular, so much of what I teach in this class is the experiences that I've had in my life. And, I've been called a genius, but the reality is I'm not any smarter than anybody in this room. And I have made my share of mistakes, but I've learned from those mistakes. And back in my youth, in my more naive period of my life, and part of it is the fact that index funds weren't around yet. When I was a young man, I had gone and bought a variety of portfolio of managed funds. I didn't have the options of indexes. And one of the particular mutual funds I invested in was called the Nicholas II Fund. And the Nicholas II Fund basically was a mid-cap fund, and it was a Wisconsin company. And it was run by Albert Nicholas, who is famous for being a great manager of money. And I had invested in that for several years. I'm not the type that buys and sells all the time. I would just buy it and held it. And I was very happy with that fund. And then one year, and what happens is when you're in a managed fund and it's not in an IRA or 401k, at the end of the year, all mutual funds have to add up their capital gains and dividends minus capital losses. And they distribute it to you in the form of a 1099. So you have, I'll get more into that when I talk about taxes and investing, but you have long-term capital gains, you have short-term capital gains, and you have dividends, which are taxed, and they're distributed out in a 1099. I remember this was the year 2000. And I would dread the 1990s because January come and these 1099s came in. And I had this whole portfolio of managed funds, and I would get these huge capital gains and short-term and long-term capital gains distributions from my investments. And it was so depressing. But, how can I could complain because they were going up, but you hate to have to pay the taxes on it if you didn't have to, but you have to because that's the system. Well, I had this Nicholas II Fund. And what happened is Albert Nicholas decided he was going to retire. And in the process of, or not retire, but he was going to lighten his workload. And he had a young sprout that was in the family business, and he decided to hand over the fund to his son. So I don't know the family dynamics or went on there, but here's what I'm just interpreting what happened. The young guy comes in and took dad's portfolio, and the Nicholas II Fund, one of its good attributes was there wasn't a lot of turnover. There wasn't a lot of buying and selling. So the capital gains distributions were pretty small each year, which means that if you hold the stock inside a mutual fund, you don't pay any capital gains taxes until you actually sell the mutual fund. But you see, this managers have the option to do this buying and selling. And when they do that, then they're passing on a capital gain, which you can't control. It's distributed out to you. Get it? That's a negative. But what happened this particular year is the son takes it over, and he must have decided he was going to be his own man. And he went out there and he sold most of the stocks in the portfolio, which had been sitting in this portfolio for many years. And they built up all this capital gains. So basically, to make a long story short, the mutual fund had a value to me of the shares I own times the share price of about 34,000. And I had a taxable distribution of 33,000 in 1 year. because of the manager and his decision to trade the stocks and pass on those capital gains. Ladies and gentlemen, that's a bad manager. I mean, these are the lessons that I had to learn the hard way, you know? So this is the problem you face in managed funds that are not inside IRAs or 401ks. Size risk. And the lovely lady mentioned that last week. What about the bigger you see, the bigger a mutual fund gets in size, the more money that comes in, the more that manager has to go out and find stocks that are hopefully going to perform well. And the more money you have to manage, the harder it is to do that because you are limited at how much you can actually invest in any particular company. And so what happens is your criteria of buying keeps getting lower and lower and lower, and thus the performance is affected. So you see this constant evolution of the more successful a fund gets, the more difficult it is to perform well. You have that risk with it. Sector risk. If the mutual fund, that particular manager, maybe his background is in banking or finance. So because he probably is an expert in that, you're into that sector risk because he's over investing in it. And you know, that sector goes out of favor. The stock market might be doing great, but that sector is doing poorly. You're going to be underperforming. That's a risk. You have that goes along with the personal bias risk of the manager. Market impact risk. That's once again, I talked about that last week. The manager buying and selling is affecting the share prices, and that makes it more costly to you in the form of performance because he's affecting the share price negative through his buying and selling. And market timing, by that I mean managers love, you see this all the time on CNBC. You get some professional guy on there and you know it sounds so smart, so good. You know, I'm a little uncertain about the stock market, so we have a bunch of money sitting aside. It's our ammunition for that buying opportunity. So what he's saying is this manager he's putting a bunch of this money's coming in, instead of investing it, he has it sitting in the bank, making nothing, waiting for that buying opportunity. So you as an investor in that mutual fund, your performance is dragged down because it's not invested in the stock market. It's sitting in a bank making nothing. That's market timing on his part, or buying and selling and taking money out, reducing the asset allocation and putting into cash. And cash flow, same thing, that's sitting in cash. So these are just a summation of all these different risks you have in managed funds, which you kind of eliminate with an index fund because the money has to get invested. And there's no bias. It's basically taking the individual human element out, and you're investing in the collective. Because the return to the stock market at any given year is the collective analysis of the smartest people in the world who are setting the value of the stock market. Okay, so I probably could show you this chart and we could all go home. Because, you know, this is what, you know, financial people love to do. They love to show you performance charts that blow you off your shocks. And you're going like, this is a sure win. Let's do it. With you with you having no understanding of why the performance was there. So I'm going to set the stage for my argument by showing you performance of index funds. You know, the history of index funds goes back a long time. John Bogle is the founder of Vanguard. And as a young man in the financial services industry, he looked at all these managed funds and he saw the things that I just talked about, that all these managers that were handling people's money after expenses were not outperforming the market. So he came up with this idea of creating an S&P 500 index fund for the company of Vanguard, which he founded. It was called Bogle's Folly. He was laughed at. He was ridiculed. What a dumb idea. How can managers are going to beat the market? They're so smart. And so everybody kind of poo-hooed, and it didn't take off right away. But over time, people started looking at this S&P 500 index fund at Vanguard, and they kept seeing this continuing of performance on the part of this fund versus all these managed funds. And the momentum kept building. And now you see there's a ton of money into these index funds. But you go back all the way to the 1970s through today. In this chart I have just goes back 20 years, but you can go back the previous 20 years and almost the previous 20 years before that. And the same phenomenon, seeing the index versus managed funds, that you see this continual number is usually 3/4 of the managers fail to beat it. And sometimes it's even, it's different, it's even worse. So basically, how did managed funds do against their indexes in 2021? What you find is 79.6% of the managed funds failed to perform their indexes. So I'm not talking about the total stock market index fund here. So you have small cap mutual funds. So you have small cap indexes of all the small companies in America, those managers, and then you have mid cap, and then you have large cap. So we're talking about the index that that manager was investing in versus, you know, a one-on-one comparison. You're not comparing a small cap manager against large cap. Get it? So in the universe of indexes, 79.6% of the managers failed to beat them. For the last 10 years, 86.1% of the managed funds failed to beat their indexes. When you stretch it out to the last 20 years, it's 90.3% of the managed funds. And you know what? It's even worse than that. How could it be worse? Do you know what survivorship bias is? This is one of the tricks of the trade of the financial service industry. Mutual fund companies love to roll out new mutual funds, kind of like cereal companies love to roll out new cereals, right? Get people to buy it because it's new. So in the universe of managed funds, companies are always rolling out new and improved mutual funds. What happens to those mutual funds if they don't perform well? Does a fund that's not performing well attract money? The logical answer is no. People don't run out seeking losers, do they? So if a mutual fund is not growing, and in fact it's getting smaller and smaller and smaller, is it a profitable product for that mutual fund company to own? Logically, no, right? Now remember, ladies and gentlemen, these mutual funds are owned. They're businesses and they're owned by shareholders. What do shareholders demand from management? How do shareholders get their money back for investing in a company? Don't answer all at once. They get it back through capital gains, right? Meaning the share price goes up. Why does the share price go up? Because the company's making more profits, right? Is the company making more profits if less and less people are investing in the mutual fund? The answer is no, because they're not paying the management fees, right? So what do mutual funds do? When a mutual fund doesn't perform, they just wipe it off their records. They take the assets and they merge it with another mutual fund. So when I'm talking about survivorship bias, I'm talking about if you take the whole universe, including the ones you kick out, the performance has to be even worse than this because they're not counting it. It's kind of like a high school. You know, there's always these knuckleheads in every high school, right? They show up, they don't do anything. They don't learn anything. They sleep all day, yet they have to take the tests at the end of the year, right? And yet they drag down the universal grade point average of the whole school. Imagine if you could eliminate the knuckleheads and just included all the kids that work hard and study. You'd think that this is a genius school, right? Well, in the mutual fund industry, that survivorship bias. really skewers the performance of the universe, because they just don't count these really bad losers. And that's so to have this, not including the survivorship bias, is really incredible. But I'm not going to end this class by this, because that's still leaving you a naive investor. What I hope for you to understand is, why does this phenomenon occur? And I've covered some of it. Obviously, it's costs, right? You got this costing. I covered the risks. There's more risk. The more risk to any activity, the more volatility and so forth too. But there's even a deeper reason. And it kind of goes back to the question the young lady asked back there last week. She went back to this. She asked me this question: is so many people are now investing because the largest single mutual fund in the world, I believe right now, is Vanguard's Total Stock Market Index Fund. And so if you included Schwab, which has one, and Fidelity and the other companies that have one, there's just trillions, got to be trillions of dollars in the Total Stock Market Index Fund. So because there's so much money in there, is this going to make it perform less? And what you're seeing is no, obviously, right? And why is that? It's because of the diversification of it. It's the market. And it will never underperform the market. Okay, so there's basically really three really good reasons. These are the three keys to getting you to understand why a total stock market index or an S&P 500 index fund will continue to have this statistical performance. One is the paradox of skill. Now, what is the paradox of skill? The paradox of skill states that as the skill level of an activity rises, it becomes more difficult to outperform by a large margin. That is so profound. Think about that in life. Take any professional activity and you realize that when you look at professionals or you look at any activity, the higher the level of competition, the more difficult it becomes to be a star and outperform. Let's take like football, for example. We are so blessed in Packer Nation to have a guy like Aaron Rodgers. I mean, you look at some of these other quarterbacks in the league, Justin Fields, and you see how lucky we are. And Aaron Rodgers, along with following up Brett Favre, following up Bart Starr in the history of the Packers, how lucky we are to have those three. But when you look at this universe of all these other teams and all these other, how difficult with all the people that play football to have people that outperform like that. I still remember I was doing this class at Oshkosh North, and that's got to be now 4 years ago, maybe 5 years ago. I think it's 4 years ago. Time just flies. But I'm doing this class and I'm talking about indexing. I'm talking about the paradox of skill. And I look over to a young man with this dynamic smile. And he was a really tall young man who came into the class. And I didn't know him, but I could tell by his interactions that he was something special. You could see that the kids just loved him. He was really a nice guy, just charismatic. And I found out later, and I asked him, "What's your name?" He told me it's Tyrese. And I said, "Tyrese, do you play any sports?" And he says, "Yes, I play basketball." And I said, "Really? You play basketball? Are you on the team? Are you a starter?" "Oh yeah, I'm a starter." He didn't tell me like he was all conference, all state, all this kind of stuff. He says, I just said he was a starter. And I said, "Okay, Tyrese, so what year are you?" "I'm a junior." And I said, "Okay, so You're at the high school level. You're at the high school Division A basketball level, and you're a starter. That's pretty good, isn't it? He goes, yeah, I'm proud of that. And I said, okay, so what is your aspiration? Well, I'd like to play college. I said, okay, what's the difference between college players and you? And he says, they're all so much better. They're just so much bigger. They're so much faster. They're so much more skilled than me. And I said, okay, so you understand. The paradox of skill states that as the skill level and activity rises, it's going to be harder for you to become a star or a player, right? And he fully acknowledged that. And I said, okay, what's the next level? He says the NBA. He didn't tell me, oh, that's where he wanted to go. He just said very humbly, the NBA. And I said, okay, what's the difference between a Division I college player and an NBA player? And he goes, it's night and day. Because it's like so hard to be an NBA player. And I said, you're absolutely right. It's just really hard to separate yourself. And yet it can be done because he did it. He's on the NBA Indiana Pacers now. He was drafted in the lottery. I never imagined it when I was talking about the paradox of skill. Yet, for all of Tyrese Halliburton's accomplishments and what an awesome basketball player he is he all NBA? Is he all pro? Is he a legend? He's not yet. Why? Because it's so very hard to get to that level of LeBron James or Kevin Durant. How many basketball players do that? And so we're talking about the universe of managed funds and people who are managing money. These are the best of the best. What attracts talent? Money. And in what industry is the most money made in this country? It's finance. Who are the highest paid people for the state of Wisconsin? Who are the highest paid employers of the state of Wisconsin? Tony Evers? No. It is the men and women that manage the retirement plan. They make way more than the governor or any employee of the state of Wisconsin. And they make peanuts compared to the people who manage these big mutual funds. So because there's so much money to be made and it draws talent. These are the best of the best. And so to outperform them, because all these managers are buying and selling against who? Themselves. They're professionals. They're playing the stock market investment game, competing against themselves. So for a manager to outperform, he has to be outperforming all the other superstar performers. And it is so difficult to do on a consistent basis. So through the paradox of skill, it makes it very difficult for any manager to rise to the level of constantly outperforming all the others, because the others are the ones that are setting the price of the market. The second one is the stock market is priced very efficiently. So all these, okay. There was a day, and I'll make the case that the market is getting even more efficient every day through technology and because of rules and regulations. But years ago, it used to be that managers had a buddy system. They would take and wine and dine some CEO and, get enough drinks in them and kind of leak some information about some product that's coming out. And it's called insider information. And, these guys would trade on that stuff. You don't do that anymore. If you do that, you get thrown in a clink. So any CEO, any person, any company, very tight-lipped about anything that's going to affect the performance or, what's going on with a particular company. So information, when it does get released, is simultaneously released to the whole world instantaneously. So to trade on information that's not known is not possible because everybody is watching all the time. So when you look at the market, it's being priced very, very efficiently. Every once in a while, there is an inefficiency. And an inefficiency usually occurs during times of high emotion, both on the upside and the downside. So I have identified many times, and I do that lesson on what makes the market go up and down. I go back to the late 1990s, and to me, the market was just euphoric. I don't know what those guys were drinking, but it was just priced insanely high. And part of it was because everybody was just throwing money in. It was like, this is the new age. You can't miss in the stock market. All this money was coming in. And because the flood of money in, it just drove up valuations to insane levels. The market was inefficiently priced. Correspondingly, oftentimes the market for short periods of time gets inefficiently priced when it sells off because of emotion. And you'll see that. But it's very, very hard to trade those, because you never know when it's going to turn around. So in general, on a day-to-day basis, most people accept the fact that the market is very, very efficiently priced. So when you're buying an index fund of the total stock market index fund, you're kind of paying a fair value for stocks. And by that, I mean, for the dollars you are paying for the earnings of the companies inside. Because it's the earnings of the companies inside the stock market and the dividends they pay that really is what you're investing for. The concept behind an index fund is you're owning corporate America. It's like a giant conglomerate business and you're owning it. And the profits they make and the dividends they pay get passed on to you. The profits get passed on in the form of dividends that they distribute, and the valuation or the share price going up is the capital gains based on the fact that the company's earnings are valued. That's the whole concept behind this. And if it's efficiently priced, you're not overpaying or underpaying in general. The final one, and that goes back to your question, is if index funds keep getting, like a total stock market index, and gets so popular that all these people are investing in, is it going to hurt you in performance? And that won't happen because of investing in the stock market is a zero-sum game. And what do I mean by that? Okay, so every year the stock market has a return. And the return is the average return. It's like a pie. At the end of the year, all these capital gains and dividends, if the market went up, forms a pie, and it gets distributed up into all of us as investors. So it's a finite thing. So you got this pie. So what you can do is you can look at the returns of the people in this pie. And consistently, what you usually see is called like a bell curve. So this is outperformance, and this is under. And what you see is a bell curve, kind of like this. You have very few people that really outperform the market, and you have a very few number of people, small number of people that really underperform. So in this bell curve, the return to the stock market is the average. It means at every year, 50% of the money underperforms and 50% outperforms. So as a total stock market index investor, because you get the average return to the stock market, you're always going to be in the middle, right? You got that? Do we all agree? Do I have any questions or arguments on my case here? It's pretty, average is average, right? Now, let's go back to the chart I show you to start this class. I'm contradicting myself, right? if 50% of the people are outperforming me, how come over 20 years I outperformed 90% of them? How come last year I outperformed 80-some% of them? Anybody got the unknown smoking gun here? Yes. If I had $1, I'd give it to you. The young lady in the front said, what about expenses? Duh. Yes. What about expenses? Because you're investing in an index fund, which has these super low expenses. So you're guaranteed to get that return, right? But when you look at all the other universe of people, they have expenses involved in what they're doing, right? And if it's 2% or 3%, okay, so if you're on the winning side, and let's say your manager returns 11% and your expenses are 2%, what's your take-home pay? It's 9%, isn't it? All of a sudden, you overperformed, but after expenses, you underperformed. If you look at the returns of most investors, because the market is efficient and there's really smart people, most of the returns here are within 1 or 2% of the average. There's not a big variation. But when you include expenses, it knocks out a huge portion, and it can be even more depending on any given year. And when you look at time, the managers that were on the winning side have a very difficult time consistently staying because of the paradox skill on the winning side. And that's why the longer time period, you see the indexes consistently get even better in performance. The only downside to a total stock market index fund or an S&P 500 index fund is they're really boring. You can't go to a party and tell everybody about how smart you are, about this fabulous stock you bought, or this fabulous mutual fund. Oh, it returned 70% last year. You know what I mean? But it's consistent and it's so effective. Just think of CNBC or Bloomberg. If every day all they could talk about is, well, the stock market did this, stock market did that. They wouldn't. Everybody wants to see this story about some guy that, hit the jackpot. We love the winners, But that's not investing. That's speculating, trying to pick those people. I once read a book, and in there they had a quote: trying to pick the next great mutual fund manager is kind of like going up to the maternity ward at Mercy Hospital and looking at all the babies and trying to pick out the next Bill Gates. It's like, okay. So I said, you look at these managers, and I said the consistency of overperforming and underperforming. This is between 2002 and 2012. How many managers? They took the top 100 in performance managers in the United States. And they said, how many repeated the next year? So 2002 to 2003, one did. Then we had a run here where we had double digits. Then we had years where 0. Then there was 9, 1, and 2. For an average of 7.1% stayed in this winning category of the best. That is a 93% failure rate. It's all about statistics. It's about odds. You may think you have a winner, but how long is that winner going to be there? It's about consistency and probabilities. And this is what I said. This is the average from 2010 to 2013. How many managers changed managers? How many funds changed managers? You can see this consistency. Even if you have a winner, the chances are they're not going to be there for your lifetime. And then I said about trading. 1991 to 1997, they analyzed these 66,000 investors. And the trading, the ones that had a turnover ratio of 258%, meaning they traded every stock in their portfolio 2.5 times over the course of that year. For that period of time, their average return was 11.4%. When the turnover ratio dropped to 76%, the return averaged 16.4%. When you talk about an index fund with a turnover ratio of about 2%, it was 18.5. So what you see is this pattern is the more you trade, the less the returns you actually get. Because you're adding in the possibilities of more and more mistakes, and you're adding in more and more expenses. And what this doesn't really calculate also is the taxes that would be involved in all the trading. Does anybody in here have a heart problem? Because you might want to block your ears. Yeah, because I've had this chart for a very long time. And, you know, I've done some classes in the senior center and some of the people got pretty pale. I was just about ready to call because they looked at this and they looked at their lifetime and they said, oh my God, what could have been? Okay. How much do these costs affect us long term? I call this chart wealth destruction. If you're paying 2% on your expenses to invest in any kind of financial product, no matter what the return is, no matter what the return, after 5 years, the 2% will take 9.4% away from the return. After 10 years, it's up to 18%. After 20 years, it's up to 1/3 of all the money you would potentially have ever made was consumed by paying that 2%. And after 30 years, it's up to 45% of the money that you made was consumed by paying the 2%. Now, ladies and gentlemen, now do you understand why it's so important for a young person to see this? And understand the person who has 40, 50, 60, 70 years of investing in front of them, the wealth that they would have had if they would have reduced expenses on what they're doing. It's mind-boggling. Almost half after 30 years. So you have a young man or young lady that comes into the workforce at 25. And she's on a job that she's lucky enough to retire at, say, 55. And she's investing in the company retirement plan and it has expenses of 2%. If she would have used index funds with very low expenses, she would have saved 45% of the expenses of the performance. It's amazing. Absolutely incredible. This alone is enough to make a person think about paying those expenses. How, first of all, think about it intellectually. How is a manager possibly going to add so much value to your money, given the paradox of skill, the efficiency of the market, and the fact that the market is a zero-sum game, that they will overcome that 45% that he's taken away in 30 years. Now, intellectually, give me an argument for going the other way. It's hard, isn't it? Okay. If you look at 100,000, this is straight math. You take $100,000 invested for 20 years, and it makes 10% annually. So this is just math here. And you have an index fund with what I call very high expenses, 20 basis points. I keep talking basis points, so I haven't explained it. That's investor speak. A basis point is 1/100th of 1%. So 1% is 100 basis points. So if you look at your company retirement plan, it says 0.7. That means it's 70 basis points. Got it? So this particular mutual fund is an index fund, but it has really high expenses in today's age, which is 20 basis points. This actively managed mutual fund, I'm not counting all the other expenses because it would be higher than this. I'm just talking about the management fee. As a management fee of 1.5%. Okay, then you take transaction costs, because in the process of investing in any mutual fund, there's transaction costs. So with an index fund, the company has to go out and buy those stocks for you. Okay, so that is some transaction costs, but it's usually very, very low. In this case, it's 10 basis points. And then we're talking about taxes, because this is not in a retirement plan. So there's dividends that are distributed on an annual basis, and that could be taxable. It could not be, it might not be, but depending on your tax bracket. But for the sake of illustration, we say that the inefficiency is 50 basis points. Now we have the active fund with an expense ratio of 1.5. The transaction costs add 80 basis points. The tax inefficiency is 1.5%. So based on these, of the 10% that you're making in total return, after everything, you end up with 9.2% in an index fund. And with an actively managed mutual fund, you walk away with 6.2. Remember, they're both invested for the same amount of time. They both have the same net return or gross return, but net returns is about 3% different. What does that mean? You end up with $581,000 in the index fund. You end up with $333,000 in the managed one. Then you gave away $250,000 because of expenses and taxes. Pretty substantial, right? It's real money. There's a really great study, and I've read it in several different books, seen it on the internet. And there's a term in investing meaning called alpha. Alpha means not taking more risk, but outperforming. So alpha identifies true skill. True skill means that you're able to outperform without taking more risk than the index you're investing in. So how do you measure risk? There's a term in investing called beta. And beta basically kind of tells about volatility. And you can look at any particular stock and they have a history of that stock or that mutual fund. And it'll tell you during up and down times, how does that particular investment move percentage-wise in relationship to the stock market. So if it was a beta of 1, that means that it's pretty much, if the market goes up 10%, that investment probably goes up 10%. If it's a beta of 2, probably goes up 20%. But conversely, on the downside, if it goes down 10%, that one will go 20. Get it? So, you can really look at the volatility of a particular investment to get an idea of the risk involved and so forth. So what they did in this study is they looked at 2,076 US stock fund managers. And so it's a long period of time. It's 1975 to 2006. So you're looking at a large representation over a long period of time. And what they found is this consistent pattern that I talked about of outperformance by the index. We found that 75% of these money managers, or 1,500 of the 2,000, didn't achieve alpha. Meaning when you take into account the risk they took versus the index they were investing in, they didn't outperform. You found that 24% or 24.5% achieved alpha. So on paper, it looked like they outperformed, but what they deducted is 24% of them did it out of luck. They may have achieved alpha, but it was luck. And the study said roughly 12 or 0.6% achieved alpha through skill. Going back to the paradox of skill, the elite of the elite in football, the All-Americans, the All-Pros. In basketball, the All-Pros, the legends. There's so few of them that actually outperform. I got that. Okay. Mutual fund performance, 2005 to 2014. This one has to do with that survivorship bias I talked about. You got 5,375 mutual funds in this particular study. And out of the 5,000, 1,032 were liquidated. 20-some% just were gone and wiped off the records. Only 147 of this 5,000 original ones actually outperformed the index, or 3%. Achieved top 25% in performance. Top 20. That's really amazing. But that just shows you how many funds actually come and go. This fair time period is an old chart, but it really shows another time period where you look at the performance of the S&P 500. And the time period was, there were 1,446 large cap blended mutual funds that invested in the stock market and total and the S&P 500 for the 10 years. That would be 1994 to 2004. 97.6% actually underperformed, or 3%, not even 3%, actually outperformed the S&P 500. Statistically speaking, that's quite impressive, isn't it? So my favorite, when I'm doing this in high school, I try to talk to the students in a term that they can relate to. And I remember doing the class at Oshkosh North with Tyrese and all the students. And I said, okay, supposing Oshkosh North gets to the state championship game, because by the time I'm doing this class, we're talking, it's probably early March. Supposing the school gets to the state basketball tournament, and not only do they get there, but they're in the championship game. It's not just the championship game, but the score is tied, and there's 1 second on or 2 seconds on the clock, and the opposing team calls timeout, but they don't have a timeout. So it's a technical foul. So the coach from Oshkosh North can look at his bench and he can pick a player to shoot the free throws to win the championship for Oshkosh North. So who do you think the coach picks? On this side of the bench, they got a guy that shot 100 free throws this year, missed 97. And on this side of the bench, they got the guy that shot 100 free throws this year and made 97. Coach, who are you putting in to shoot the free throw to win the game? Pretty obvious answer, right? So I got the student, he raised his hand. And he's like, really, I got it. Mr. Kemp. He couldn't wait to tell me the answer. And I said, okay, who are you picking? I couldn't wait to hear what he had to say. So he says, I'm picking the guy that missed 97. And I'm like, what? Why are you doing that? And he said, because he's due. But I mean, there's a man with a good future. I mean, that is what you call a person that's got a glasses half full attitude towards life. Pretty impressive, right? All right. Okay. So this chart, John Bogle's book, it's called Chances of Beating an Index. So what he found is the chances that a manager will beat its index for 15 straight years is 1 in 223,000. The chances that a manager will pick his index for 21 straight years, or beat his index for 21 straight years, is 1 in 31 million. Statistics. So I haven't had a chance to do this for a very long time. my mind works in very weird ways. I can't understand it all the time. But when I was making this chart, all I could think of is one of my favorite movies of all time. Dumb and Dumber. The original Dumb and Dumber. And there's a scene in Dumb and Dumber that absolutely reminds me of this every time I show this chart. So what I need to do is I need to act this out. This, and I need not a volunteer. I'm going to pick this person because nobody will volunteer. And I want them to come up here and act out the scene from Dumb and Dumber with me so that you can make this point. And I'm going to pick you because you are absolutely right here. Come on, right here. Yes, yes. You look like you have some severe, really artistic ability. So the people on Zoom, the people in here, I need to prep her for this performance. Okay. She's ready. She's ready for her acting debut. This is giddier because the Zoom people just really need to see you. Now look at her and look at me. I mean, okay. Okay, so the scene goes like this. She's the lovely Mary. And in Dumb and Dumber, Mary is this beautiful woman that was in the limousine, and Jim Carrey was this like driver of this shuttle thing. And she gets in, and he, looking in the rearview mirror, obviously falls in love with her. She is his dream girl. And as the scene goes, eventually she gets out to the airport and she exits the vehicle and forgets the briefcase in the back. And he's longingly looking at her, going and dreaming of his life together with lovely Mary. And then he looks in the back and he sees the briefcase and he goes like, oh my God, I got to give it back to her. So he reaches and runs in there and he's chasing after her. And then she's entering the plane going to Aspen, Colorado. And he's like, can't get on. So the whole movie is about him, this journey with him and Jeff Daniels. If you haven't seen it, you have to. Why it didn't win an Oscar is beyond me. But anyway, the whole movie is about him and Jeff Daniels returning this basket. They don't know what's in it, but they find out there's money in there, which they go and spend, but they put IOUs in there. But anyway, Mary doesn't know this. So they end the scene. There's this lovely, she magnificently walks into the room. She's glowing. She's radiant. She's absolutely beautiful. And then you have Jim Carrey. He's, Jim Carrey. Yeah. Look like a complete loser. Okay. And he's got the briefcase and she's like, oh my goodness. She's just like overwhelmed that he brought the briefcase because she doesn't know that he spent all the money. That's beside the point. She's beyond happy to get this briefcase. So of course, Jim Carrey thinks this is his opportunity because she's his dream girl. And she walks in and he hands her the briefcase. And he says to lovely Mary, what are the chances that a guy like you and a girl like me could ever get together? No. Oh, not good. Okay. Not good. Okay, not good. Okay, now, I'm a big guy. I can take this. Like, give it to me. What are the chances that we could get together?
Why didn't it agree? Did I say it right?
Yes. So what you're saying is I got a chance. Give her a hand. What a performance. That was outstanding. Every time I see that movie, it just reminds me of this is people investing. It's like it's like 1 in 31 million. It's like 90%, 20 years. It's on and on and on. And yet, people chase the dream. They chase they see these things, they don't know any better. So next time someone's bragging to you about their performance of their investments and all their kind of thing, yeah, a lot of times it's interesting too. People will brag about their performance. So I mean, I can go back to one of these charts and you see like, let's look at this one, like right here. I mean, this guy's at work and they're like, man, I have done so well the last 20 years. I just been putting money in and I have $330,000. Not knowing that it could have been over $500,000. You know what I mean? Just remember, Dumb and Dumber. And do the right thing. Give yourself percentages. All right, awesome. Thank you. So that's my case for using indexes and index mutual funds like S&P 500 total stock equities. Anybody got any questions? Yes.
Yeah, I have an index fund with bank. And unfortunately, it's in the traditional IR. I'll be turning 72 in February. What do I need to do? When do I need to do it?
Okay, his question is, he has an index fund at Vanguard. And believe it or not, he's going to be turning 72 coming up. Now, how have you done with that?
Good.
He's done really well. So he's facing the dreaded RMD. And what does RMD means? It's in a traditional IRA, it means required minimum distribution. People lose sleep over this. People agonize. First of all, are you retired? Okay, what are you living on? And so you don't really need this money. Okay, well, I was going to say, normally we get into the retirement thing and you got to live on something. And for a lot of people, just taking the RMD is part of their normal money they need to live on, right? But in this case, you're lucky enough to have a pension and Social Security, so he really doesn't need it. So what the darn government's doing is making him pay taxes on a gift that the government gave him, in which he had a lifetime of compounding, tax deferred, and now, oh my God, he's got to pay taxes on it. This is so terrible. It is not. It's not a big deal. It's like a little over 3% of the actual principal. And so if you're at Vanguard, what I recommend you do, or what I do, is simply the first week of January or whatever year you have to do it.
Turn 72
And February of next year. So I would, next year, what I would do is in January, I would call them, because you can do it anytime next year. And I would just say, you can pick a date to have the RMD. I like to do it right at the first week of the year. Because, for instance, I am at that age, and I did mine the first year, and look at the market was down how much, and so I sold before I got that money out before. But in my case, I used it to live on. But in your case, what you can do is simply, it's awesome, is do you have any concept of your tax bracket? I mean, is it 12%? So what you can do is just have Vanguard. So they tell you, okay, you have a distribution of $33,000. So you can instruct them to take 12% off for the federal, and then take maybe 5 or 6% off for the state of Wisconsin. You pay them.
I can actually tell them on.
Right.
I thought it was prearranged.
No, you can dictate, you can have no taxes withheld if you want, but I like to pay the taxes right in the beginning of the year. That way I don't have to pay estimated taxes all year. I just get it out of the way.
Why is it?
Because at the end of the year, you're going to pay the taxes. You're going to have to pay the taxes, and it's part of your income that you're going to have to pay estimated taxes on. And so, I mean, why not eliminate the estimated taxes, get it paid out ahead of time?
I can just pick a number, basically what I want to pay for taxes.
Right. You can't take out, in the federal, you can't take out less than 10%. You gotta take at least 10%. So I always like to get it out of the way and get it paid. And then the remainder, I'll be talking about things like a tax managed balance fund. Or even if it's in an index fund, like the total stock market index fund, you could just put it in an index fund, total stock market index fund outside in a personal account. It's very tax efficient. You can reinvest the proceeds if you don't need it.
Do I have to do this every year?
Yes.
You know, I want to figure out how.
Oh. You'll be surprised. Really, people, I love Roth IRAs, but many people would be out ahead in return by traditional IRAs versus Roths. Because in your younger years, before you retired, if you were in a higher tax bracket, then when you retire and you're in a lower tax bracket, you're penalized because you paid higher taxes originally, put the money in the Roth. Roths come out ahead when you are in a higher tax bracket when you retire than when you put the money into the Roth. So you unknowingly, naively, were brilliant.
I've been worried